Sounds like a lot to do. That's why we would track the positions in the PowerOptions Portfolio Tools. Took one today that fell about 347. WP carry, it's trading at 57.38. So the day it opened, it was, about 60.70, 60.90. So I put in that I had purchased the stock at 60.85 at or around yesterday's close, and I sold an in-the-money 60 strike, really an at-the-money 60 strike, for $1.70. And the max expected return was 1.4%. But as you can see now, the stock has dropped 5.7%. If I close the position, my liquidation loss would be 4.2%. And if I hold it for the next, this is a standard March, this is not a weekly. But if I held it all the way to expiration, March expiration 35 days away, and the stock remained at this price of 57.38, highly unlikely. It's going to flop around up and down, I'm sure, between those time frames. But as the time decay comes out, my loss would only be 3% due to the $1.70 premium I collected initially. Now, Shashir, what am I going to be doing when I enter this position into the portfolio? I had the portfolio. I clicked to enter it as a covered call. It gave me the trade entry field. I put in my entry. Once my position is entered, what is the next thing I'm going to do? I'm going to go to this alerts column here on my position. I'm going to click view. And I'm going to set alerts for percentage stock change of, let's just say 4%. Okay, and I'm going to mark that as a red warning. A bad sentiment, yes. And I'll mark that as a bad sentiment indicator. I could also use the lower stock limit, i.e. putting in your break-even point for the covered call position. Or there's just a standard stock price limit. You can put in limits on the option delta. The comment that came in from James, you could put in the delta upper or lower limit if you wanted to be notified if your delta changed. Also, the range in the money. If I started off 1 or 2% in the money or 3% in the money, but I wanted to be notified if I'm now out of the money, then we could put that in as well. Total position percent change. Normally when I'm opening a covered call position, I'm looking for stocks that are trading above the 20 or the 50-day moving average. So I may want to be notified if the stock drops below the SMA 20. Mark that as bad sentiment as well. Or if I'm within, let's say, 4 days to earnings, or maybe 4 days to ex-dividend date as well. Various alerts that you can put in based on the time value, option change, stock percentage change, delta, days remaining to expiration, range in or out of the money, similar to delta as well, and probability. Once I've set my basic alerts this year, go ahead and click Save Alerts. And there we go. Now when I go to my portfolio, any positions I have opened where an alert's triggered, it's going to show me that, whether it's a green, good sentiment, red, bad sentiment, or yellow, just a meh sentiment. Usually the yellow I set is for days remaining to earnings. The long-term married puts or the calendar spreads, for example, diagonal calendar spreads, quote-unquote, poor man's covered calls. I want to know if I'm within 5 days to the ex-dividend date or 5 days until the earnings. I just mark that with the yellow because it says, hey, you got some time things coming up here. You might want to consider adjusting your position in preparation of earnings, good or bad. Leave some of the upside open, add extra protection, and so forth. Now I see my alerts, of course. I can click on view, and it says, yep, you got it all. Stock is now trading below your 20-day moving average. That's why it dropped today, 0 days till earnings. So I typically would not even have had a covered call open through earnings, honestly. And the stock decreases at 5.7%, which is greater than the 4% limit that I hit. By the way, as a subscriber, you don't see this on the trial account, but as a subscriber, I can select to have these alerts emailed to me across all of my portfolios. So what? All right. Now that my alert's been triggered, yes, I'd have about 8, 9, 10 other positions open in addition to this one. Now it's time to evaluate my adjustments. What can I do now? I have a loss of 4.2%. If I liquidate, I'll lose 3% in the hope that maybe the stock still stays around this $57.35 range in 35 days. Unlikely. What management would I do? And as I'm tracking positions in the portfolio, that's when we're going to go to position actions and then position analysis. The position analysis view gives you a breakdown of our original position, basic standard hockey stick profit and loss chart. Where we are right now, the remaining time value on the option, the delta has dropped to 0.28. We know where we are right now, the current liquidation value, the original expected return was 1.4%. Current liquidation value is minus 4.2%. And we have a loss of 3% in 35 days. if the stock remains at 57.38. And down below, we have the new rollout opportunities. So we originally sold for $1.70, and we could buy this back for 70 cents. So we're going to keep $1 premium. And it shows we can go to the slightly in the money April 55 call for a premium of $3.80. With my initial dollar that we kept here from this decay in the call premium, my new adjusted credit would be $4.80. But remember, my purchase price was $60.85. So this would put me at a price, if I sold the 55 call for a $4.80 credit, that would only give me $59.80 back. I'd still be at a loss of 1.9% if I was assigned at 55 at April expiration. But we're going another strike in the money. It's a defensive maneuver. It's not the current loss of 4.2%, and it's lower than the loss of 3%. Or, of course, the April 60 call only gives me a net credit of $2.13, but if my expectation is I think this stock's going to recover after this poor earnings event, after this decline, I think it's going to stabilize because it was on a good move. But hey, I'm also seeing the sell warnings crop up. Maybe I'm a little bit more hesitant, but if the 60 call at $2.13, if I do get assigned at 60, that would convert it to a 2.2% return. And of course, I could also hold on right now if I think it was an overreaction to the earnings with this pullback of about $4 today. And excuse me, I think it's going to come back to maybe my break even. Maybe I don't need to roll or adjust. Now, it's great to see things numerically, but as you're evaluating a rollout opportunity, you can always click the more information button and go to simulate trade. And that gives you the side-by-side comparison. Your current position now, where the stock is, and your current loss of the position that we know, the original max expected return, and what the new position would look like if I rolled to the April 55. Now, in the background, there are some programming that's done to find the rollout opportunities. We're only seeing 2 here. If I can get, lower this down to only a loss of 1.9% by going to the April 55 with an adjusted net credit of $4.80, could I maybe have a positive return if I went out further, if I went out to August or maybe went out to June or went out to September or October? It's possible, but it doesn't like to show rollouts that far out because we want to keep it within a reasonable time frame here. But if you had a rollout in mind that didn't appear and you want to see it, you can always do it manually. On the position analysis view, click What If Calculations. This just takes you to the standard profit and loss chart. You see your position as it stands right now, and down below, of course, you can continue to run your what-if scenarios. If the stock continues to drop, what is my expected monetary loss going to be? If it recovers in the next 5 days, 6 days, back up to 58, 59, 59.50, what might my gain or loss look like? You can do that analysis in what-if scenarios down here at the bottom. But up at the top, I have the ability to take a look at, here we go, look at the full chain. We've got July, and January. Okay, so there's not that many series remaining. Maybe after standard expiration on the 16th, we might see an August or a September come up. Right now, we just have April, which we saw in the rollouts, and July. Let's take a look at July. So what am I going to do? I'm going to use this tool to simulate buying to close my March call. I have to do that first. So I click on the March series. We show that the March 60 call has already been added. I'm going to click it again. And we're going to tell the system we're going to buy it back for $1. I'm sorry, 70 cents. It was $1 adjusted net credit, midpoint's at 70 cents. Okay, so we're going to buy this back at 70 cents. Fantastic. Now, what is that going to do? At a cost basis of $60.85, collected $170, bought it back at 70. New cost is $59.85, and I essentially just have a long stock position. Let's clear this up. Let's click these options out. This is an easy one to do because of the monetary value. And let's just put in my new cost basis. If I bought to close this option, is $59.85. Let's take a look at that July 55. Priced at 430 to 630, so midpoint of 530, but probably not going to get that with the volatility. Look at these bid-ask spreads after this move, 640 to 10, 11 to 1480. Yeesh. But let's say we did get the midpoint at 530 for this July 55 call. Let's go ahead and sell that. And now we do have the potential in 161 days to make 0.8% if the stock remains above 55 after this pullback. I know this doesn't match your trading plan for covered call positions this year. 0.8% every 161 days, you can do better than that. Okay? And there's, as we saw, there's many opportunities, and the search tool can find thousands and thousands of other opportunities that match your trading plan. That's what it's designed to do in addition to our default screens this year. Okay? But again, that might not be the best route to take. You might be better off managing shorter term, as we saw, down to April, or rolling down. Same thing with the weekly. Sometimes you have to roll 3, 4, 5 weeks out in time, maybe 2 months or more out in time to roll for a credit after the stock has declined and still a positive assignment. But again, if you don't want to do that, there are other alternatives that you can do as well. Stay in the position, wait for it to recover. Don't necessarily want to run out and buy a put option now after this decline, because the puts are going to be pretty expensive after this move with the poor earnings naturally that came out, or poor guidance that came out for WP Carry. So that's going to cost a fair amount of money from the original position to hedge it now that the move has happened. Just like a spread position, though, I likely wouldn't be carrying a covered call that I was hoping to get assigned on just for the standard return through earnings. I typically would avoid earnings between now and expiration using the filters and power options in that case. So another idea there is the stock repair tool. And what does a stock repair tool do real quick? Well, we can go ahead and put in WPC. I'm sorry. Oh, there we go. I'm going to put in WPC. And my cost basis was going to be $59.85. That's after I buy back the call. So I'm just in a long stock position, $59.85. That's trading at $57.38 or so. All right, no repairs matched it in this case, which is fine. And it's due to the strike difference. So what the stock repair tool does is it tries to build a ratio repair. Essentially, you're going to buy maybe a 57.5 call if it was available and sell 260 calls to get a credit. But although that sounds like a ratio call spread, which it is, you're selling to at the higher strike, say at 60. Sorry about that, 60. And we're going to buy one at 57.50. Okay. Now, although that looks like it's probably only able to be done on a level 3 or probably a level 4 position because one of these two calls would be naked, what you're really doing is doing a covered call where one of your two calls is linked to your stock position, and then you've got a bull call debit spread with the bought 57.50 and the sold 60 strike. So the idea is, as the stock moves back up towards your initial purchase price, you're getting back to break even here, and with the help of getting the 2.5 points back on the debit spread from 57.50 to 60. And you did this debit spread and this extra call. Commonly, we look for it at a credit if possible, rather than doing a debit repair. So that's just another option for managing the covered call positions.